As a real estate investor, it's super important that you understand tax laws. Tax laws, what dictate how people invest in real estate. So, problem with condos, which I build, is that they get counted as ordinary income. So even though I can generate massive returns, investors don't like condos because of the tax treatment. On the other hand, apartments are able to be treated as a capital gain when you sell them, and so they can roll the profits into the next project. So the money follows the tax rules. Previously, commercial buildings were ran on a 39-year depreciation cycle. Under the new bill, it's actually only 27 and a half years. But that did cause an oversupply problem like we're experiencing now. Nashville is a perfect example of that market where there's tons of oversupply and you're giving months and months free concessions and rent on apartment buildings. So if you don't understand tax rules, you can make big investment mistakes. I've seen people actually be driven only by tax implications and do bad deals that barely make a return just because they're trying to 1031 into a property or get a cash flowing investment. On the other hand, you're better off, sometimes doing a screaming deal that you make a lot more money on, even if the tax implications are worse. So you really have to understand taxes as a real estate investor because it can be, if it's an afterthought and you're not doing your planning in relation to your overall estate, you can make some big mistakes. My name is Meg Epstein, and as a developer, I've built over $300 million in real estate. Some of those assets have been apartments and industrial buildings that are, cash flowing investments. And on the other hand, I built ordinary income condos that get treated, differently when you go to sell them in terms of taxes. But what's funny is I've noticed that I still net on a tax basis make a lot more on the condos because of the high profitability, and it's much, much less competitive than cash flowing assets like industrial and apartments in this current environment. So as a developer, I've had institutional investors for the past 6 to 7 years. And what I've noticed is that back before this last recession, so call it 2021, was that so many groups like bigger pension funds and insurance companies were throwing money at apartment buildings and industrial because of how they're structured on a tax savings basis. And I was very allured by all of that capital. So I built, over $100 million worth of industrial and apartment buildings because it was very, very easy to raise money, even though the foundation of my development company was condos. And what I noticed though is that it really actually, in the end, wasn't as profitable as you would have thought because so many people are chasing that tax treatment. And so, in my experience, you really have to look at, the deal and net out the tax return as opposed to just chasing asset classes that end up well oversupplied. So when I've delivered apartment buildings versus, condo buildings, net for net, even if I paid full ordinary income taxes on the condos versus the apartments and industrial, I still ended up netting much more money on the condos as an example. So I've learned a lot about, tax treatment. You do have to be very sophisticated in doing institutional real estate. But I do think it's, you have to do enough analysis and not just shut off opportunities because they're not, traditional asset classes. So back to the big, beautiful bill. We're going to just walk through a few of the things that the bill changes. One of the first thing is that it reinstates 100% bonus depreciation, meaning if you buy things for your real estate or equipment, you can write off the entire amount of that purchase. So another aspect of the beautiful bill that affects real estate is the Opportunity Zone program. The Opportunity Zone program is made permanent with a rolling redesignation of certain areas, and there's more benefits for those rural areas. Another aspect is you can still get your tax gains treatment after the year 2026 for 5 years, which is something that no one really knew what was going to happen after the year 2026 with the OpZone program. So That gives you 5 more years to defer cap gains. And then the basis step-up period for long-term investments is also modified. So the Opportunity Zone program is here to stay under the new beautiful bill. So another big tax implication change with real estate is if you're building a manufacturing facility in the US, you can 100% write off the cost of that construction. Nothing like that's really been done before, I don't think, and so that is to incentivize onshoring and manufacturing in the US, but that's a huge, beautiful tax incentive from the bill. So overall, it's very important that you understand the tax implications of the real estate you're investing in and really look at the asset classes and how they're treated differently. Obviously, consult a tax professional and not just look on YouTube. But these are just some, higher level thoughts. And it's one thing that's very important to make sure is not to have the tail wag the dog in terms of only chasing real estate that's tax incentivized versus looking at your net overall return. So that's what's really important. So obviously you need to consult a tax professional in terms of investing in real estate, but it is very, very important that you do understand tax implications and not just seek asset classes that are tax advantageous but are low returns. So you need to really look at the net return of your investments. I hope you found this helpful. These tax rules and the economy is changing all of the time. So if you want to check out a video on how to keep things going during unstable times, please watch this next video.